Here's going to be everything you need to know before you start considering buying a stock, an ETF, a crypto coin, gold, etc., any investment. So the first thing you need to ask yourself is, what is your goal? Because at the end of the day, nobody can give you investment advice, and you yourself can't even research investment advice if you don't know what your goal is. And your goal can't be as simple as to just say make money. Because what does that mean? Do you want a safe investment, kind of a nest egg for retirement, and you're willing to sacrifice potential higher gains for the safety? Are you looking to double your money this week? Are you looking to double your money in the next 10 years, but you're fine with a safe option that just has upside? Are you looking to just have fun? You're just going to throw a couple dollars here and there in the stock market and hope something booms? It solely depends on what you're looking for, what you expect, what your risk tolerance is. Some people, the best investment for them, for their goals, is they want to throw $500 into a risky penny stock, and if it fails, they're fine with that. Some people have $500,000 and they've got 10 years left to live, and they're trying to somehow make that squeeze. So your investment goals, you could never go on YouTube and someone tell you this is the best investment. You have to it begs the question, well, for what? What are we investing for? So with that being said, I'm going to talk about some of the basics within the stock market, and we'll talk about crypto and some other futures. So when you're looking at a stock, if you go on Yahoo Finance or on Robinhood or Webull or Fidelity, any of the major stock exchanges, it doesn't really matter at the end of the day. They all pretty much do the same thing. They let you trade for free. They have some fees. Even Robinhood, which claims to have no fees, they have some small fees. But regardless, get whatever app you want, doesn't matter. And generally what people would recommend, and I don't think this is bad advice, but as I'd mentioned, it all depends on your goals. So the S&P 500, the Dow Jones, and the NASDAQ. The S&P 500 are the current, as of this quarter, the 500 most profitable companies in the United States. Not most profitable, the 500 highest market cap companies. And what that means is, as you can see market cap down here, Apple is worth $4 trillion. So I did have a bit of a hiccup right there where I said most profitable, because a company's value isn't how much profit it churns out. It's what the public is willing to pay for it. And you might ask, well, why is that different? Why would anyone pay for a company that's not profitable? Or why would someone pay more for a company that's less profitable than another? And it's all about projections. It's all about projections, because there might be some companies, for example, Walmart was more valuable than NVIDIA. Not currently, it's not, because NVIDIA's absolutely lapped it. But so many years ago, Walmart was more valuable than NVIDIA. And before NVIDIA started making more money than Walmart, its market cap, which essentially means $273 times the amount of shares. So if Apple has 1 million shares, then it's worth $273 million. Obviously, it's not. We'd have to divide 273 by 4 trillion to get how many shares there are. But you get the point. The reason why NVIDIA, although it's very profitable now, the reason why it was selling for more than Walmart was before it became more profitable than Walmart was because people were saying that in a short order, in 5 to 10 years, it will be very profitable. So what you have to understand in the stock market is, a lot of people will talk about profits, about losses, about ratios and stuff like that. And although that's important, I'm not saying to not do any technical analysis. What's important to understand is the price of the stock, the literal price, but more importantly, the market cap. That is an indication of what the public is willing to pay for the company. So I am saying that I believe Apple, the entirety of Apple, because I'm buying 0.000000001% for $273. I'm saying at this current moment, I believe Apple, the stock I've got pulled up, is worth more or even to $4 trillion. That is what I'm saying by buying it. And a lot of people get that mixed up. A lot of people, they think that if a stock is less than $273, for example, let's say Lowe's. Let's say Lowe's is $100 a share and Apple is $273 a share. Apple Apple's share costing more doesn't mean the company's more valuable, because every company issues out a different amount of shares. So whenever you're buying a stock, the real question is, what is the market cap? Is it $4 trillion? Is it $2 trillion? What do you think this company is worth? That's the question. It's not about the literal stock. The stock price is completely irrelevant, because sometimes there's stock splits. And what that would mean is Apple could say that if there's 8 million shares, Apple could say we are going to cut every share in half, meaning every share would be half as valuable. So instead of being worth $270 a share, it'd be worth half of that, $135. The market cap wouldn't change at all. So whenever you're looking at a stock, an individual stock, Apple, Lowe's, Home Depot, McDonald's, you want to look at the market cap. Do I think that this sector, do I think this company, do I think that they will grow? Now, something that you should look at also, that's pretty important, is going to be the S&P 500. So what a lot of people, went a little too far down. What a lot of people recommend is to just buy an ETF that mimics the S&P 500. One example of that would be a company called SPY, S-P-Y. If you type that in up here, you will find a company that tracks the S&P 500. Now, the S&P 500, as we mentioned, is a culmination of every company that is in the 500 most valuable companies. So this is an average of all of them. If the majority of them are doing well, but a few of them are doing bad, you're still going to make money investing in this. And this is the 1 year, you're up 13%. And if we look at the 5 year, you're up 90%, so getting close to double. And all time, it is 38, yeah. And that's if you invested when it started, so you'd have made a pretty penny. But regardless, generally, when you're investing in ETF, something that is relatively safe, obviously what we can see here over a 5 year time span is we had this pretty big drop in 2025. You had this big drop. You also had this big drop in 2023, and then you had the COVID drop. So although we've had 3 pretty big drops in the last 5 years, as you can see with COVID, with the 2022 inflation bubble, and then with the tariff bubble, or not really bubble, but tariff issue, although we've had 3 big drops, if you invested 5 years ago, you'd be up almost double. So the ETFs are generally considered a safe investment. Now, that doesn't mean that the stock market couldn't go down 50% for the next 10 years. Anything is possible. Every company could all of a sudden, we could have a super socialist or super communist leader come in and make all the profits go back to universe. Like, anything could happen. There could be mass violence in the streets. So I'm not trying to say that ETFs, which would mimic this, are 100% going to be profitable, because they're not. As we can see, if you invested here and sold here, you lost money. But if you invested 30 years ago, you made a lot of money. And the only thing is, there was that's a 5 year, we've got a 5 year span if you invest in 2000 where you didn't make any money and you actually lost money if you would have sold. So the key thing, as I've mentioned, is before you invest, you need to know why you're investing. Are you investing for long-term growth? If you're investing for long-term growth, with all of the information we have, as you can see, long-term growth, the best bet would most likely be an ETF that mimics the S&P 500. That would be the best bet. With that said, anything can happen. Nothing's definitive. The stock market could hypothetically go to zero. There would be bigger issues than you losing your money in the stock market. Because if Walmart's not making any profit, if ExxonMobil's not making any profit, we've got some issues in the homeland of the United States. Now, with that being said, I generally recommend most people do ETFs. If, for example, we're going to pull up this is FinViz, F-I-N-V-I-Z. It's a very good website. So a lot of people like to invest in ETFs. It's very safe, and what an ETF is it circles all of these companies, all of them, and says we're going to invest in everything. And as you can see, we'll go to a 3-year performance. As you can see, there is some red here, 50% down, some red here. But overall, if you invested in everything here, you would be up a lot. Nvidia's up 1,000%. So that is why a lot of people like to invest in ETFs, especially in the United States. It's a very robust economy that makes a lot of money. Now, what some people like to do is they like to buy individual stocks. I trust Apple. So although, as we'd mentioned over here, the 5 years up 90%, Apple individually is up 97%. So if you would have invested in Apple, you'd be more profitable than if you would have invested in the whole market. Because if you invest in the whole market, you do have to accept some of this baggage with, being down 40%, being up only 37%. So yes, investing in Apple would have been better than investing in the S&P. What some people like to do, and this is an interesting thing, would be to invest in technology. So what they do is they invest in Microsoft, they invest in Oracle, they invest in Palantir. So some people, they want to be safe, but they don't want to be so safe that they open themselves up to doing this stuff and investing in everything. So what some people do is they'll invest in a whole market. Instead of investing in everything, or instead of investing in just Apple, they'll invest in Nvidia, Broadcom, Advanced Micro Devices. I don't even know what these companies are, but you get the point. So you could invest in a stock, you could invest in a sector, and what that would mean is you would just Google technology ETF, and it'll spit out some technology ETFs, and you can look at those. So that, are we getting an ad? Volvo just popped up. Anyways, so you can invest in a stock, as I'd mentioned, which is the most risky. If we're talking about the stock confines, if you're going to invest in a stock, one stock is the most risky, but has the most upside, with Nvidia up 1,000%. A sector is kind of in the middle. It does have some risk because look at this sector. It's down. This sector's down. But if you invest in this sector, you'd be down less than just the worst loser. And then you can also invest in everything, and that's the most safe generally. Now we're going to talk about some other investments. So we're going to look at futures for all these various things. 5-year note. You can get bonds. Bonds are definitely going to be super safe, but the return is also going to be very low. A high interest yield account is also going to be very safe, obviously. How much should you want to lose? Okay, well, we're not really talking about that right now. And here is crypto. So if you're not going to invest in the stock market, you have crypto to discuss. And the main players, we have Bitcoin, we've got Ethereum. Maybe some people would argue Solana. I wouldn't argue Solana makes any sense. I think if you're interested in crypto, which crypto at the end of the day is just a hedge against inflation, 21 million Bitcoins, no more get mined. With dollars, they get printed every day, so you understand the logic behind Bitcoin. And this is definitely, Bitcoin and Ethereum are very risky investments, I will admit. Although I am personally invested in them, and I'm trying to get more than it's a 30 month. That's not 30 month. What is that, 30 day? I don't even know what this 3 stands for. Anyways, regardless, here's the Bitcoin chart. So 21 million coins, obviously we can see it's absolutely skyrocketed. And crypto generally is going to be considered, even if it's Bitcoin or Ethereum, which are the more established coins, it's definitely more risky. Look, there isn't really any utility if you buy Walmart. If you own enough of Walmart, you get on the board, you get paychecks, you get dividends, even if you only own one share. So that is, Bitcoin is solely a form of currency, and the only reason it's more valuable than it was yesterday is because more people have adopted it and accepted it. So I will admit, although I do own it, Bitcoin is definitely a very risky investment, and it could go either direction very quickly. So I probably would not recommend it for people who are trying to save money. If they're just, I'm fine making 3%, I'm fine making 5%. If you're investing in Bitcoin, you could invest, some of your, if you're going to invest $100,000, investing $5,000 in Bitcoin is probably fine. Worst case scenario, you lose it all. You could still be profitable within your portfolio. If you're going to be investing, all of your money in crypto or 50% of your money in crypto, there's a very good chance that you lose it all. If you invest all of your money in stocks, more specifically ETFs or sector-based ETFs, very unlikely you lose it all. It's possible, but very unlikely. Now, one thing I didn't want to talk about, I'd mentioned dividends, so we might as well discuss dividends within stocks. And essentially what a dividend is for most companies, now there are some companies that pay monthly, but companies, what they do, especially if they're more established and have been around for a while, is they will provide, as you can see down here, where's it at? Forward dividend and or yield. So that is going to be 0.4%. So $1. And that is going to be paid out throughout the year. Some companies will pay once a year. Some companies will pay 3 times a year. Some companies will pay 12 times a year. You can just find that on any stock. What's the dividend yield? Some companies don't have a dividend yield if they're newer or if they're more tech-based. Now, I know Apple is a tech-based company, but they've been pretty established. And what that does is that provides some utility. Because if I own Apple share after enough years, if I bought the share for $100, after enough years, I would have made back $100 in the dividend, and then I would also still own the stock. So to some degree, it is a passive income. Now, you do have to pay taxes on it, but it is viewed as income. So depending on how much money you're investing, or if you're investing in a bigger, this is a pretty low dividend. This is about as low as it gets, 0.4%. If you're investing in, let me pull it up, Realty income. Well, there we go. And it's loading, but Realty Income is a company I own, and they pay 5.7%. So if you buy this share for $56, they will pay you, and now they pay you every month. So this is going to be divided by 12. But if you buy one share, they're going to pay you $3 this year, $3 next year, et cetera, et cetera. And that adds up. That adds up pretty quickly because soon you will have paid for the stock fully through dividends. Now, another investment that a lot of people talk about is, before we get into real estate, we're going to talk about metrics, a lot of metrics within stocks. So with crypto, it's going to be super complicated to look at all the different metrics and stuff, but for stocks, a little bit easier. The exchange, if you go on FinDiz and you're looking to screen out, because this is a good tool. If you have specific things you're looking for, this could help you out. So go on FINVIZ and go on Screener. Exchange does not matter, completely irrelevant what exchange you're on. Market cap. So market cap is going to be, as I'd mentioned, that is how much the company is worth. A lot of people look at the price. They say, no, let's get off that so you can see the numbers. So this company down here, this company, as you can see, the shares are going for $10, but the company is worth $284 million. And then you just keep looking down, and you can see that the price of the share is different than the market cap because every company gives out a different amount of shares. So the only thing you need to look at, you don't need to look at the price. Now, you do need to look at the price in the sake of how much am I going to spend. Am I going to spend $1,000? Okay, this is how many shares I can buy. But never look at the price. Never compare two companies and say Lowe's and Home Depot, they're in the same sector, but Lowe's is cheaper, and I think Lowe's is better. No. Lowe's isn't cheaper because the share price is lower. You have to look at the market cap. Okay, with that being said, so market cap. Generally, and this is going to be a general rule because this is a lot of exceptions, mega companies, over $200 billion are worth, very established companies that you have heard of, they are going to be very safe. So we'll pull up. Went the wrong way. So these are the biggest companies: NVIDIA, Apple, Microsoft, Google again, Amazon. You get the point. Very safe. When a company's worth a lot, they are generally going to be pretty safe. Not always. And a lot of companies that have a market cap that is, we'll go back to this direction. So this company is worth $60,000. Vestland. So a lot of you could probably buy this company outright if you've got $60,000. But obviously it's going to be very volatile. We've got up 82%, down 18%, down 50%. Very volatile because the companies are small. Earnings date, completely irrelevant for beginners. Don't worry about that at all. Price, once again, this is completely irrelevant. The price of the stock is completely irrelevant. The market cap is how valuable the company is. The price isn't. Index doesn't matter. NASDAQ is generally more tech focused. The Dow is generally more industrial focused, but that doesn't really matter. Dividend yield. So this is interesting. Excuse me. Some companies, they do not pay a dividend. Now that is not an inherently bad thing. It's not an inherently good thing to pay dividend. It's just something you need to look at. Do you want that additional 1 to 2% income? If you invest in heavy dividend companies, you might get 3 to 5% of your investment in dividends, which is just free cash that you have to pay taxes on. But some companies, it just depends on the overall picture on what you're looking for. A dividend doesn't make a stock good. Not having a dividend doesn't make it bad, but that's something that does matter. Average volume doesn't really matter. If you get under 50K, well, even if you get under 500K, getting a little suspicious there. Target price. So what a target price is what is it expected to reach in the next year? What the company, what the insiders, what they are saying. I wouldn't really worry about that too much. You can get into some projections. Sector, something that's interesting, you could filter out. You could say, I only want healthcare companies. And if you think that market's going to boom, short float, irrelevant, relative volume, once again, don't worry about it. IPO date, that's just how long the company's been around for. That could be important information, but not inherently. Industry is just more specific to sector. Analyst recommendation. This is, do they think this is a buy? Do they think it's a strong buy? Do they think it's a sell? That is something that could matter. I don't generally, I wouldn't, if you have a specific reason for buying a stock, now I wouldn't recommend buying stocks. I would do ETFs or industry-based ETFs. But if you really want to buy a stock and you find reasons that you think the stock is going to be worth more in a year, not that you think the company's cool, not that you went into Pizza Hut and the cashier flirted with you, that's not a reason to buy Pizza Hut. The reason to buy Pizza Hut is for whatever reason if you think that they are going to be more valuable and or more profitable in the next year to 5 years to 10 years. So that's the only thing you need to be looking at, but that could be important. Current volume, I wouldn't worry about it. Doesn't really matter. Country, a lot of people only want to invest in the United States for obvious reason. We're going to get some other. So PE ratio, that is going to be price to earnings. The lower, the better. But generally, newer companies, because we're expecting them to grow, are going to have a higher PE ratio. So just because the PE ratio is low, it's not a 1-to-1 in the sake that a lower PE ratio makes a company better. Price to cash, once again, intuitively you would think that having more cash on hand is good. It sort of is, but once again, a company like Tesla, it didn't have any cash on hand until they became profitable, and they were still worth a lot. Earnings per share growth, obviously you want growth, duh. Earnings per share growth, EPS, you want you want the company to have grown. And then sales growth, obviously, you want it to grow. Operating margin. This one isn't as clear cut as the previous, because companies like Tesla, as I'd mentioned, they were losing money before COVID. Until like 2020, they were losing money. So an operating margin isn't necessarily bad. Institutional ownership's an interesting one. Now, this one isn't bad or good, but if 90% if the owner owns 90% of the company, he's very invested. If he only owns 1%, he's less invested. So that might matter to you. Forward PE, wouldn't worry about it. Wouldn't worry about this. EPS growth, net profit margin. Once again, we already discussed that. Price to share, debt to equity, insider ownership. This is pretty much the same thing as institutional ownership. And yeah. Now we are going to talk about stocks, talk about crypto. Gold is kind of similar in that crypto realm to a hedge against inflation. And gold doesn't really have utility. It sort of does, but I would say it's pretty similar to crypto. Only has value because other people value it and view it as a form of currency. Same thing with the dollar, but the dollar is losing value. Now, in terms of homes, if you're investing in homes for for profit. I would say it's kind of in the same camp as buying an. It has some. It mimics an ETF in some ways, in this in the sake that it is very safe to a degree. But I view a home, if you're buying a rental property, now if you're buying 100, that's different. If you buy a rental property, in my opinion, it would have the downsides of owning a single stock, and that the renter could trash the place, that the renter could burn it down, that the renter could not pay, that the renter could squat, that the city could lose jobs. So I view owning one home as very similar to owning one stock. But the difference is one stock, as we'd mentioned, could go up 1,000%. Let me find it. Yeah, so a stock could go up. Hold on. Is it going to load? We'll go 10-year performance. All right, so 10-year performance up 26,000%. So if you invest in a single stock, it could go to zero, obviously. But if you invest in the right stock, it could go up 26,000%. If you invest in a home, you hope that in 10 years it's worth double. That's the good. If you renovate it, if you've got good renters and they don't do anything and they're paying, you hope that you're able to rent it out and the home increases in value. I would say if you're buying, if you had, a good sum of money that you could buy a home outright. Now, if you're taking out a loan to buy a rental, I find that extraordinarily dicey if you're buying one home. Now, more likely than not, you're going to make money. Duh. I'm not saying if you buy a rental, you're going to lose money. No, you're probably going to make money. In more cases than not, you're going to make money. But I think taking out a loan to buy one rental has a lot of possible downsides. And the upsides are capped, because what is a home going to go up in 10 years? Maybe it's going to 2x, potentially. With a stock, obviously you have a lower barrier of entry because you can buy $2 of a stock. You can buy fractional shares of stock. I would lean towards, now if you got $10 million and you're going to buy a bunch of different rentals, even if one rental ends up in Youngstown, Ohio, and nobody can live, or is that Youngstown, Pennsylvania? I'm not sure which state Youngstown is in. But even if the price of the home goes down 75%, if you own 100 homes, you're going to make money almost 100% in any circumstance. So I would say if you've got a lot of money, renting, buying homes, and real estate probably is better than the stock market. If you have under $10 million, I would say probably the stock market makes the most sense. Also, you have the caveats of gold and or crypto are good investments. And yeah, I would say that's kind of a general, in unbiased. I'm not selling anything. I'm not saying you should buy my course. It's going to be a general understanding of investments if you're newer.